As we move on with the stockholders' equity section, we're going to talk about the effect of stock dividends and of stock splits. Sometimes corporations distribute to shareholders additional shares of the company's own stock rather than cash. Now, these are known as stock dividends or stock splits, depending on the size of the stock distribution. Suppose you own 100 shares of stock. Assuming a 10% stock dividend, you'll get an additional 10 shares. A 100% stock dividend equivalent to a 2-for-1 stock split means 100 more shares. Large stock dividends, 25% or more of the shares outstanding, and stock splits are declared primarily due to the effect they have on stock prices. Let's say that before the 100% stock dividend, your shares are trading at $40 a share, so your 100 shares are worth $4,000. After the 100% stock dividend, you have twice as many shares. It sounds good, but let's really look closer. Since the company as a whole still has the same value, each share of stock is now worth 1/2 of what it was before the stock dividend. Your 200 shares still have a $4,000 value, the same as your 100 shares did before the stock dividend. But now each share is worth half as much, $20 a share rather than $40 a share. Total assets, total liabilities, and total stockholders' equity do not change as a result of a stock dividend. Now, this slide summarizes the effects of a stock split and a stock dividend. So as you see here, there's no change in stockholders' equity. In a stock split, there's no change in common stock, but there's an increase in a stock dividend. In regards to retained earnings, there's no change with the stock split, but there's a decrease with the stock dividend. And with a stock split, there's a decrease in par value, yet with a stock dividend, there is no change. This slide shows the disclosure American Eagle had in its 3-for-2 stock split. The stock split was distributed on December 18th to stockholders of record on November 24th. All share amounts and per share data presented herein have been restated to reflect this stock split. Important to note, declaring dividends and splits is like cutting a pizza into more slices. Everyone's got more shares, but each share is really worth proportionately less than it was before. Let's take a look at exercise 1010. On September 1st, the Board of Directors of Colorado Outfitters declares a stock dividend on its 10,000 $1 par common shares. The market price of the common stock is $30 on this date. We're going to record the stock dividend, assuming a small 10% stock dividend. Then we'll record it assuming a 100% stock dividend. Then we'll record it assuming a 2-for-1 stock split. So again, go back to this page. When we record a stock dividend, we're going to have an increase in common stock and a decrease in retained earnings. When we record a stock split, only our par value is going to change. So, to record a 10% dividend, we are going to debit stock dividends, 10,000 shares times 10% times $30. We're going to credit common stock for $1, the par value, and credit additional paid in capital for $29,000, recording a 10% stock dividend. Next, to record a 100% stock dividend, we're going to debit our stock dividends at $1, and we're going to credit common stock for $10,000. Then, recording a stock dividend, assuming a 2-for-1 stock split, there's no entry that's going to be recorded because everything stays the same. Remember, in this case, the value will be decreased. A company has 1,000 shares of $20 par stock outstanding, issues a 2-for-1 split. How many shares are outstanding after the split? 2,000 shares. If a company had 1,000 shares and issued a 2-for-1 split, then after there would be 2,000 shares. Now let's talk about reporting stockholders' equity. We're going to prepare and we're going to analyze the equity section of a balance sheet and the stockholders' equity, statement of stockholders' equity section. The statement of stockholders' equity summarizes the changes in the balance in each stockholders' equity account over a period of time. The stockholders' equity section of the balance sheet presents the balance of each equity account at a point in time. To contrast the stockholders' equity section of the balance sheet and the statement of stockholders' equity, in this slide and in the next slide, we'll compare both statements for Canadian Falcon. This is a snapshot of stockholders' equity at the end of 2018. And then in the next slide, we'll see how each equity account changed during the year. So as you see here, the preferred stock, $30 par value, 100,000 shares authorized, but 1,000 are issued and outstanding. Then we have common stock, 1 cent par value, 1,000,000 authorized, 2,000 are issued and outstanding. We have additional paid in capital, and then we have retained earnings. Now on this slide, as you see here, each of the beginning balances in this slide is 0 because this is the first year of operations. The beginning balances for the following year on January 1st of 2019 are the same as the ending balance for this year, December 31st, 2018. The statement of stockholders' equity reports how each equity account changed during the year. So for instance, the common stock account increased because Canadian Falcon issued common stock and declared 100% stock dividend. The additional paid in capital account increased from the issuance of common stock, the issuance of preferred stock, and the sale of treasury stock for more than its original cost. Retained earnings increased due to net income and decreased due to both cash and stock dividends. The retained earnings column is sometimes shown separately and referred to as a statement of retained earnings. The repurchase of treasury stock is shown as a reduction because treasury stock reduces total stockholders' equity. The ending balance in treasury stock is 0, since all the treasury stock purchased was resold by the end of the year. Here's another question for you. How does the stockholders' equity section of the balance sheet differ from the statement of stockholders' equity? A, the stockholders' equity section shows the balances at the point in time, and the statement of stockholders' equity shows activity over time. B, the stockholders' equity section shows the activity over time, and the statement of stockholders' equity shows the balances at a point in time. C, there are no differences, or D, the stockholders' equity section is more detailed. I hope you get that one right. The stockholders' equity section of the balance sheet shows the balances at a point in time, but the statement of stockholders' equity shows the activity over the period of time. Let's look at exercise 1014. United Apparel has the following balances in its stockholders' equity accounts on December 31st, 2018. Treasury stock of $850,000, common stock $600,000, preferred stock $3,600,000, retained earnings $2,200,000, and additional paid-in capital $8,800,000. Prepare the stockholders' equity section of the balance sheet for United Apparel as of December 31st, 2018. So the stockholders' equity section will show the preferred stock of $3,600,000, the common stock of $600,000, the additional paid-in capital of $8.8 million to give us a subtotal of total paid-in capital. Then we will show our retained earnings of $2,200,000, and then when we reduce our treasury stock minus $850,000 for a total stockholders' equity of $14,350,000. We're going to now evaluate the company's performance using information on the stockholders' equity section. Earnings are the key to a company's long-term survival. However, we need to evaluate earnings and compare them to the size of the investment. A useful summary measure of earnings that considers the relative size of the business is called the return on equity. Now, the return on equity, or ROE, measures the ability of company management to generate earnings from the resources that owners provide. We compute the ratio by dividing net income by average stockholders' equity. Let's take a look at this ratio by examining the results of two large clothing companies. Now, investors are also interested in knowing how much a company pays out in dividends relative to its share price, and that's called the dividend yield. That's computed as the dividends per share divided by the stock price. So Ralph Lauren is probably best known for its polo clothing line. We can compare its profitability with a competitor in the clothing industry, Abercrombie, that owns both the more expensive Abercrombie label and the less expensive Hollister line of clothing. The clothing industry has been struggling in the face of higher competition. Lower cost clothing stores like Forever 21 and H&M have further increased competition in an already crowded clothing market. So this slide provides certain financial data for Ralph Lauren and Abercrombie. So you see here, we've got net sales, we've got net income, beginning and ending of stockholders' equity, the ending stock price, and the dividends per share with the number of shares outstanding. The return on equity for both companies is calculated in this slide. Ralph Lauren has a very respectable return on equity of 17.4 compared to only 3.3 for Abercrombie. A return on equity of 17.4 suggests that for every dollar of investors' resources, the company has earned an additional 17 cents just in the current period for its investors. With Abercrombie, the return on equity is only 3.3%. It's reflective of the struggles experienced during this period by the clothing industry as a whole. Ralph Lauren's continued popularity has allowed it to rise a bit above the competition. Now, the dividend yields for Ralph Lauren and Abercrombie are shown here. Ralph Lauren's dividend yield is 1.4%, is less than half the dividend yield for Abercrombie at 3.2%. Dividend yield is an extremely common ratio used by investors. Now, it's interesting here because the dividend yield for Ralph Lauren is lower, but the return on equity is higher, so Ralph Lauren probably doesn't feel a need to have to pay out the dividends that Abercrombie needs to pay out. Earnings per share measures the net income earned per share of common stock. We calculate earnings per share as net income minus dividends on preferred stock divided by the average shares outstanding during the period. Now, the upper half of the fraction measures the income available to common stockholders. We subtract any dividends paid to preferred stockholders from net income to arrive at the income available to the true owners of the company, the common stockholders. If a company does not issue preferred stock, the top half of the fraction is simply net income. We then divide income available to common stockholders by the average shares outstanding during the period to calculate earnings per share. Earnings per share is useful in comparing earnings performance for the same company over time. It is not useful for comparing earnings performance of one company with that of another company because of wide differences in the number of outstanding shares among companies. Investors use earnings per share extensively in evaluating the earnings performance of a company over time. Investors are looking for companies with the potential to increase earnings per share. Analysts also forecast earnings on a per share basis. If reported earnings per share fall short of analysts' forecasts, then it's negative news, usually resulting in a decline in the company's stock price. Another measure widely used by analysts is the price-earnings ratio, also known as the PE ratio. It indicates how the stock is trading relative to current earnings. We calculate the PE ratio as the stock price divided by earnings per share so that both stock price and earnings are expressed on a per share basis. Price-earnings ratios commonly are in the range of 15 to 20. A high PE ratio indicates that the market has high hopes for a company's stock and has bid up the price. This slide calculates the price-earnings ratios for Ralph Lauren and Abercrombie. The price-earnings ratio for Ralph Lauren and Abercrombie are 16.4 and 34.1 respectively. A low price-earnings ratio indicates to investors that a stock is priced low in relation to its current earnings. Ralph Lauren's PE ratio is in the common range of 15 to 20, while Abercrombie's is much higher at 34.1, indicating that investors expect future earnings to be much higher. A key point to note here is the return on equity measures the ability to generate earnings from the owner's investment. It's calculated as net income divided by average stockholders' equity. The dividend yield measures how much a company pays out in dividends in relation to its stock price. And earnings per share measures the net income earned per share of common stock. The PE earnings ratio indicates how the stock is trading relative to current earnings. We're going to finish by going through an extensive exercise, exercise 1017. On January 1st of 2018, the general ledger of Grand Finale Fireworks includes the following balances. So here we see a trial balance of the accounts for Grand Finale. Then we see a list of transactions that we will need to record. So you'll see here in January, issue an additional 2,000 shares of $1 par value common stock for $40,000. In January 9th, provide services to customers on account, $14,300. January 10th, purchase additional supplies on account, $4,900. Anyway, it continues to go on. So we're going to need to record each one of these transactions. And from there, we're going to create some adjusting entries. We're going to then prepare an adjusted trial balance, create the financial statements, record closing entries, and do some analysis. So we've got a lot to cover in this exercise. So the first thing we're going to do is record the various transactions. January 2nd, issue an additional $2,000 shares of $1 par value common stock for $40,000. Now, as we know, the common stock will just show the par value. The additional paid in capital will show the extra that was paid, received for the cash. So we debit our cash of $40,000. We credit common stock, a credit of 2,000 shares at $1 par value per share, $2,000. And then the credit for additional paid in capital of $38,000, showing our comment, our memo, issue common stock. January 9th, provide services to customers on account, $14,300. As you see, we debit accounts receivable since it's on account, and we credit our service revenue with our memo explanation, provide services on account. On January 10th, purchase additional supplies on account, $4,900. We will debit our supplies for $4,900 and credit accounts payable with the memo, purchase supplies on account. January 12th, repurchase 1,000 shares of treasury stock for $18 per share. Remember, with treasury stock, we do not care about the par value, but we will care about what this amount here is. We repurchased for $18 a share, so then when we reissue it, this is important to know. So we debit our treasury stock for $18,000. We will credit our cash for $18,000. Remember, treasury stock is part of the stockholders' equity section. It reduces stockholders' equity because we're buying back our own company shares. On January 15th, pay cash on accounts payable, $16,500. So this is reducing our liability. We will debit a liability of $16,500. We will credit cash, showing we paid cash on account. January 21st, provide services to customers for cash of $49,100. We will debit our cash and credit service revenues for $49,100. Next, we receive cash on accounts receivable of $16,600. Here we will debit our cash for $16,600 and credit our accounts receivable. Again, we're reducing our receivable because they've given us the money. January 29th, declare a cash dividend of 30 cents per share to all shares outstanding on January 29th. The dividend is payable on February 15th. So we will, at that time, it's a legal obligation, debit our dividends of $3,300, which is basically 10,000 shares of outstanding stock plus 2,000 minus our treasury stock times 30 cents. So we've got $3,300 as a debit and a credit to dividends payable. January 30th, we reissue 600 shares of treasury stock for $20 per share. If we look back when we purchased them for $18 a share. So here, in showing that we purchased them for $20, we are going to debit cash for the full amount. The treasury stock will only be for the $18 a share we purchased them for. So as we're now reissuing them, the difference between the 18 and the 20, the $2, will be credited to additional paid in capital. Then January 31st, paid cash for salaries during January of $42,000. A debit to salaries expense, a credit to cash. Now we need to record our adjusting entries. The first adjusting entry is unpaid utilities for the month of January are $6,200. We'll adjust our utilities by debiting the utilities expense and crediting utilities payable. B, supplies at the end of January total $5,100. Well, we had supplies initially of $7,500 here, you can see. So what we will do in our adjustment is the $7,500 plus the supplies we purchased on account of $4,900 on January 10th, we add to it, minus the $5,100 are available, which means we've utilized $7,300. So we will debit our supplies expense of $7,300 and credit our our supplies of $7,300 to reduce our supplies by the amount we have used. Now C, depreciation on the equipment for the month of January is calculated using the straight line method. At the time the equipment was purchased, the company estimated a service life of 3 years and a residual value of $10,000. So in order to figure out the depreciation, we will go back here to the front to see our equipment is $64,000. So our equipment being $64,000 minus our residual value of $10,000 gives us the amount that we will depreciate of $54,000. Divide that by 36 months gives us $1,500 that we will depreciate for the month of January. And then D, accrue income taxes at the end of January, $2,000. We'll debit income tax expense for $2,000, credit income tax payable for $2,000 to adjust or accrue for income taxes. Then our next step is to prepare an adjusted trial balance. So as you see here with this adjusted trial balance, we have basically taken all the beginning trial balance, plus we have adjusted all the various numbers by the various transactions we've entered plus our adjusting transactions. And so I'm trying to go back to where I was. So our adjusted trial balance has our debits and our credits spelled out. And as you see here, we will account for each of these balances. So for example, with cash, we began the period at $42,700, and we go through each time we debited or credited cash. So let's take this example. So we start with the cash of $42,700. Then from there, we have a debit to cash of $40,000 on January 2nd. We have a credit to cash of $18,000 on January 12th. A credit to cash on January 15th for $16,500. A debit to cash on January 21st for $49,100. A debit to cash on January 22nd for $16,600. A debit to cash on January 30th for $12,000. A credit to cash on January 31st for $42,000. So from there, between the debits and the credits, we take all of those to come up with a new ending balance of $83,900. We do the same with accounts receivable. We started with $44,500. We had some service revenues on account, and then we had where customers paid the accounts receivable. We end with $42,200. Our supplies, the same thing. What we started with, what we purchased, minus our adjustment at the end of the period. Our equipment has not changed. Our accumulated depreciation, in fact, did change with our adjusting entry of $1,500 for the month. We do the same with our accounts payable. The utilities payable stayed the same. Our dividends payable, we did not start with any dividends payable, but we, with the utilities payable and dividends payable, we had adjusting entries. Same with the income taxes payable. Keep going down through this list and work through how we ended up with the adjusted trial balance. From there, we prepare a multiple step income statement. So if we look at the trial balance, we're going to take the items for the income statement. Now, the income statement consists of the service revenue and all of the various expenses. So as you see, the service revenue of $63,000 versus the various expenses provide us with net income of $4,400. From there, we will create a balance sheet. The balance sheet can be created from our adjusted trial balance. Now, we know that our income statement is going to be added to our retained earnings. So our retained earnings is the beginning balance of retained earnings plus our net income minus the dividends that were paid gives us our ending retained earnings balance of $46,200. You see our total assets equal our total liabilities plus our stockholders' equity. As you note in here, since we have treasury stock, you see it's a negative balance here in the stockholders' equity section. It reduces stockholders' equity. Once again, if we purchase stock from another company, that would be an asset, an investment. But when we purchase our own company stock, it is not an asset. It is part of stockholders' equity, and it is a reduction because we are buying it back. We then record our closing entries. Closing entries eliminate temporary accounts. The temporary accounts are the revenue and expense accounts along with our dividends. So to zero them out, we basically service revenue, we will debit it into, and then the credit is retained earnings. For the expense accounts, we credit those to zero them out and debit our retained earnings. And then with our dividends account, we zero that out by crediting it and debiting retained earnings. So then our trial balance will only consist of those permanent accounts. Last, it asks us to analyze various types of ratios. Return of equity ratio is taking our net income, dividing it by our stockholders' equity section. Now the stockholders' equity is going to be the beginning stockholders' equity plus the ending stockholders' equity divided by 2. As you see here at the beginning of the period, our stockholders' equity section is going to be our common stock, our additional paid-in capital, plus our retained earnings to give us our beginning stockholders' equity section of 135.1. Our ending stockholders' equity was 170,200. As you can see here, the common stock, the additional paid-in capital, the retained earnings minus the treasury stock gives us the 170,200. So you take the beginning and the ending stockholders' equity, divide that by 2 to come up with an average. So our net income of 4,400 divided by our average stockholders' equity gives us a return on equity ratio, ROE, of 2.9%. Compared to the industry average of 2.5%, Grand Finale Fireworks is more profitable than other companies in the same industry. But these are monthly calculations, not annual. So, granted this is January, I would assume that this company probably receives a big portion of their earnings during the 4th of July period. So, again, you need to look at a bigger spectrum than 1 month. But this shows that they are more profitable than the industry average. Analyze the following for Grand Finale. How many shares of common stock are outstanding as of July 31st, 2018? We calculate that by the 10,000 shares at the beginning of January. We issued 2,000 additional shares on January 2nd, and then we repurchased 1,000 shares on the 12th and reissued 600 on January 30th. So if you take the initial plus the initial additional issued minus treasury plus what we repurchased or reissued, we have 11,600 outstanding shares. Calculate the earnings per share for the month of January. Is earnings per share better or worse than last year's average of $3.60? So as you see here, earnings per share is the net income divided by the average shares outstanding. We see that the earnings per share is 41 cents. Is that less than $3.60? It does look it. Our last question, the PE ratio, price earnings ratio. Is it typically more than 100? Equals the stock price divided by net income? Is typically less than 1? Indicates how a stock is trading relative to its current earnings. The PE ratio indicates how a stock is trading relative to its earnings. The PE ratio equals the stock price divided by earnings per share. Generally, they're in the range of 15 to 20. There you have it, guys.